Well, we've already seen in recent weeks quite a significant move higher from the lows in a short period of time. The initial decline that we had was quite orderly, so it wasn't really a major stress event, I would argue, in terms of the volatility that you saw in the market. Europe, yes, you did see some quite significant moves, but in the US, it was generally much more relaxed. It was only really at the beginning of March you started to see, for example, credit spreads widen, so funding costs really start to increase, the first sign of some genuine stress. But that was quickly turned around, and we've now had almost a 10% move from the lows, and the VIX, I think, today broke below 20. So I think in this market, it's surprising how, on a short-term basis, some of these flows technical flows can drive pricing. And that's been a feature where we have not just increased volatility, but volatility of volatility. So in terms of the VIX, you're seeing it jump in a bigger range, whereas historically it's been quite stable in these low teens. You're now seeing it at a higher level, but jump quite frequently from 20 to 30, for example. And that, and then back down. And those quite frequent changes in the volatility regime, again, for GRM, allow some opportunities to monetize some of that, which is helpful. There's no shortage of things to worry about. I mean, but again, markets can surprise you. You know, if you look at 2019, if someone had said we're going to have a global pandemic, shutdowns around the world, we're going to have a major war in Europe, we're going to have surging inflation, we're going to have central banks tightening, where do you see the S&P 500? You'd probably say not up 30%, which is where it is. So I think there are a huge number of risks out there, but timing market turns is very difficult. So that's why we think having a balanced portfolio with some diversification avoids the need to make that timing call, but makes you robust for whatever the future may throw at you. And there are, as we've been talking about, lots of things to worry about. I think people do need a replacement for bonds. So bonds can play a role in a certain type of environment. I think we've become used to such a long period of disinflation with this downward trend in rates that we've assumed that bond always play this diversification role. Whereas when you look longer term at history, it's actually, you get very long periods where bonds and equities are highly correlated. They're typically more when there are concerns around inflation. And so what you've seen with bonds is that we come from a period when bonds had positive returns, they had this defensive behavior, this negative correlation to equities. So in a portfolio context, they were super attractive. You then, as yields came down, you've lost that return component, but you still had that negative correlation. So you look at last year, for example, when there were concerns around growth, when equities dipped, it was typically because of concerns around growth being impacted by COVID or Omicron, and bonds would rally in expectation that central banks would ease. What you've seen more recently is that the dynamic is equities are actually concerned about central banks now focusing on inflation and moving to tighten interest rates. So bonds and equities have been moving together. So when you have a low level of absolute yields and you have no diversification benefit, then people are starting to question, what is the point of having, what is the role of this allocation in my portfolio? And you're seeing sentiment towards bonds becoming very negative. And so in terms of this 60-40 portfolio, that very attractive combination that's worked over a long time with rates falling and providing diversification, people need to find a new model or a new way of managing that risk, that diversification for the environment that we're currently in.